Hello, guys. It's another good day that we're going to learn a few things that will help us to be profitable traders and somehow to understand the market structure. And remember, what I always tell people is that, guys, it's very important for you to understand how the market moves and also to understand what the patterns that you see in every chart actually communicates to you, because everything that you see in a chart is communicating something to you as a trader. So, and as a trader, those things are what actually you have to look for. And something that is very important for you to know also is that as you are learning few things here, it's very important for you to look on your chart and see if you can actually spot these patterns. Why? Because as you spot these patterns and also scrolling back in the past on your chart, it will actually help you to see that indeed this what I'm showing you guys is actually what is actually happening on the chart, right? Because for you to be able to use a strategy and that strategy to work for you, that it have to convince you enough that indeed this patterns that I'm showing you guys, they are working. Because until you are being convinced, you have to convince yourself and look through the chart for you to be able to and to get to a point where you'll be a profitable trader and trusting on your analysis, right? Why? Because even if you can take a pattern and then that pattern doesn't work out, but just because you know that 60% or 80% of the time those patterns they tend to play out, you won't feel discouraged that somehow you don't know how to trade. Okay, because what kills most of our trade of us as traders is that maybe 2 or 10 bad trades, they make you to want to scrap away your strategy, but knowing that even though you know that most of the time those patterns, when you trade them, they work. Okay, typical example, even if you trade support and resistance, you might find that if you were to focus only on that strategy where you are trading support and resistance, percentage value, you might find that 60% of the time that support and resistance strategy, it works. It's only the 40% that doesn't work. All right, and remember that if you use a consistent lot side and proper money management, at the end of the trading period, you would have made 60% profitable trades. And yes, you will find that 40% they were not profitable. Okay, so at the end of the day, you are a profitable trader. That is how it is, guys. Okay, so the odds should always be with you. Like you make most of the trades are positive, and then just few they are on the negative. All right, but if you gamble, like I always discourage you guys to gamble. If you gamble, what will happen is that you're going to lose your money quickly, and you're going to quickly get discouraged. All right, because one thing that actually discourages you also as a trader is that as you when you wipe your account, there are only two scenarios or two ways of dealing with that. Is either you are discouraged that you don't know how to trade, or is either it motivates you to look or try to master the strategy that you are trading. Okay, and the other thing also that tend to always come to our mind is you'll review your trades, right? And which is also important, you'll review your trades. After reviewing your trades, you're going to find where you went wrong. Why? Because whenever you lose, you'll always find how you made a loss on that trades. Okay, so you trade after reaching a certain number of trades that you're taking. Maybe you can say, okay, today I'm going to just execute maybe 20 trades. After executing 20 trades, what do? You do review, right? You find why you didn't manage to why other trades lost and why other trades won. I get it. So after that, the review or the feedback that you will get after that review, it will actually inform you on how to behave on the future trades. Okay. But if you are an emotional trader, it will be hard for you to review your trades. Why? Because you'll always look at the chart and like, okay, I know it's a sell and then you take a sell. Oh, it's a buy and then you take a buy. Not based on anything. Okay. If it's such way, you can't review your strategy and try to correct yourself. Why? Because the only thing that you'll need to correct or to start on with is your emotions. Control your emotions and control them. Like control your emotions, guys. That is very important and that is very key. All right. And the other issue that I want to address to you also is that as a trader, guys, it's very important that you have to take out emotions, take out your money issues, your struggle out of trading. Okay, but yes, your struggle should actually force you to study hard and try to master what you are studying. Okay, that's that your that sometimes I call it your why. Your why is what will actually help you to understand in the first place why you needed or you wanted to be a trader. Okay, so you know your why, and after you know your why, you will know that you have to be super organized and you take this as a business, and you take this as something that you know if you master it, you understand it, it's going to make you to be financially independent, and it's going to complement your other sources of income. All right, which is very important, and that's the main reason why most of you guys or most of us we are here and learning to trade. All right, so uh, with that, in short, today, guys, we're going to learn about the importance of scoring imbalances. Like example, if you remember well, I was showing you that there are some things, there are patterns or zones that we trade. Okay, we draw our trend lines. After drawing our trend lines, what do we do? They create an imbalance. An imbalance, it means an area that is of an interest to us, that we want to enter our positions there. All right, so we don't just like example, across a break of a trend line, or when your trend line gets crossed, it doesn't mean that every time you have to enter a trade. Okay, there are few things that we have to look at before you can get on a trade. All right, so the first thing is here why it's very important for you guys to score imbalances. All right, and scoring imbalances, it will also help you not to gamble. All right, why? Because you will be trading like a robot. Okay, trading like a robot, it means you are following your strategy to the latter. Okay, if it doesn't go with your strategy, what do? You don't take that trade. All right, so importance of scoring an imbalance, also it helps you to determine if actually that trade that you are getting on, it will give you enough risk to reward. It will give you enough profit if you take it, okay? Because sometimes you'll find those nice levels, but when you look a ratio of risk to reward or the profit margin, you might find that it's low, okay? If it's too small, which means it's too risky. Too risky means you can't take it, okay? So that is why it's very important for you guys to do something we call scoring the imbalances, okay? So now, the first thing, the first thing that is very important is every trade, before you execute it, there is something we call consolidation away, right? A consolidation away, it means the level should move from that level that you are seeing. It should actually be super strong for you to trade on, okay? I'm going to share the screen here so that you can, this image here, so that you can see what I mean, okay? That's okay, that's one. And number two is this one here. Okay. Okay, cool. Yeah, if you look at that chart there, all right, we have one full open high close low candle consolidating away from the level. So when you look here, okay, where's my annotation? Yes, there. All right. So you'll always find a level like this. Here, price was doing what? Was dropping. You'll find a basing. After that, a basing, you'll find this candle. This candle is called ERC candle. Okay, it means this is called, this we call it a base. Then it will rally high, and then whenever you see a candle closing above this area, this candle here, it have to close above. It have to close above this place or that area, okay? And it should be actually longer than the base. This candle here, okay, it should be longer than the base. So look how long this candle is. The next candle should be actually more than 2 times the size of the one that where price turned, or which we normally call it a base. All right, if that happens, we say it's consolidated away. We call it a consolidating away from the level, meaning price have left that level. Okay, so the first full candle consolidate away from the imbalance, and then they should be, most of the time they also should be, before price go down to touch the area, there should be a candle that is not part of the second one. Okay, like example in this area here is this one. After that, whenever you see that happening, it means now in this area, that's where you can prepare to enter your trade. Okay, so when this happens, just forget the red, just assume the red ones is not there. like this candle number 1, I get, and then this one is number 2. When that happens, it means you can get here and do your prepare to enter your trade. Okay, so look at this. Let's look at this one here. This one, guys, is not a proper level. Most of the time they fail. Okay, why? Price, after price consolidate away, like after price leaves this area, we expect it to create another candle here, and then that's when it tests this one. So a pattern like this, it means, or we call it, price was tested on departure, or the level was tested on departure. Okay, this area, it had to make another candle here before it went down. All right, so in short, for consolidating away, we want, or price, or can say the candle. Okay, let me put the whiteboard. Okay, so which means if price was falling like this, okay, and then we'll have a nice base here, and then now it turns, we always need this candle. When you see this candle, it means you can draw your level. Okay, why? Because after that, yeah, it can continue going up, but the level is valid, meaning there is an imbalance there. So most of the time, we expect price to go reverse, test the level. After that, it will go up. Okay, that's what we mean when we say consolidation away. All right, and then the other thing is called the strength of the impulse. Okay, so the strength of the impulse, it means the candles, let's assume price was dropping here. Okay, base, right? So if you find candles that are leaving the area with those explosive moves, it's a super sign that that area it's a strong imbalance, or the impulse is super strong, or the strength on that level, it's strong, meaning when price reverses, there is a high chances, like mostly I'll say 80% chances of price touching this area. When it touches this area, it after that it goes up like that. All right, but the areas like this, let's look at this one. If price leaves the area with just small candles like this, okay, small candles like this, we consider that level very weak, meaning there's a high possibility that when price comes down, it's going to break that area. All right, so in short, guys, super strong area like this is valid. Okay, we want to see the levels that are like that. Okay, so let's check on the charts to see if we can find strong levels. Okay, all right, okay, so let's look at this pair here. Not sure if it will have a nice okay on the, So on the weekly, okay, actually the common traded pair is euro US dollars. So let's check this one out. Okay, object list, all delete. Okay. Okay. Yeah, when you look at this, let's look at this chart here. This is euro USD. Okay. We have few levels here. This is a proper level. Look how price moved from this level. This move was super explosive. You see how price went that fast up. And then look also at this one here. Okay. This level also, it had a nice move up, like price was moving up explosively. Okay. And you can see, when you see this candle, this is where actually price consolidated away, meaning this area become a valid area to trade on. All right. That is why when price came here, it touched this area and then it went up. Okay. This is a monthly chart. So even here, we expect price is already in this area here. Okay. So because this area is strong, when price touched this area on the first time, it touched and then it closed here. Okay. That actually what always happen on the strong levels. All right. Let's look for another level. Okay. Yeah. Same thing here. The level was strong. Sometimes, yes, the levels, they can take months actually to materialize. It just depends on what time frame you are trading on. Look, price, nice level, consolidated away with this, up. After months of going up, it went back, touched the area, went back up again. And this also is still, guys, is a level. This is also is a level. Look, this candle here, this is a basing candle. Okay, close here. And then it consolidated away here. Or this is where this candle is what made this, what validated this signal that said, okay, we can trade this area. Look, price touched the area. After that, it went up. All right. Okay. So this still a C piece. Okay. So like, look at this. These are weak areas. Like you can see, these are star steps. Okay. So it's weak area. So usually price, when it comes to this level, it just passes without even pausing. Why? Because the areas are weak. Okay. Let's look on the lower time frames. This is our weekly time frames. As you know how we trade supply and demand, guys, it's simple. We use what we call trend lines. I got it. So let me go drill it down to weekly so that you can see something here. On the weekly, this area, arrival zone. Look, just look at this level here. What happened? This area was nice, so price moved up, came down, come down here, it came down here, touched it, and then it went up, right? So any other valid area, this area here, these are poor basins, okay? These are weak levels. Look what happens when price went down, it just passed those areas without even stopping, okay? Check if I can find examples of the weakest ones. So you can, what is the difference here? This is an example of the strong area, okay? So that's why price, when it touched this area, it reacted to that. Another example of the strong level is here, okay? Whenever price touches that area in future, it reacts, okay? These two, this level, yeah, it was strong area. Price crossed it. Why price crossed it? The reason there, it's actually based, the reason why price has to take out this one, it was actually saying we are on the downside. Why? Because on the H4, actually, this area, not sure if you can see it, there will be this area. Some people, they call this the inter-exchange. So price, when it gets to this area here, where is it? It created a pause, which we can call it a CP, yeah, which in future, what happens? Price goes back to touch it and then it goes down. Okay. Yeah. Examples of strong levels that most of the time holds. This here, strong level. These are strong levels. These are still strong levels. Okay. Yeah. And also, for this one, I'm just showing you examples of the levels that actually are strong and consolidated away or moved away when after they were formed. Okay. And remember, when you trade supply, it's not all levels that you trade. Though a level might be strong, if a bigger time frame or a time frame that is bigger than where they were found, it's already in control, it means when price start going down, it will eliminate that. As price eliminate those levels, it will give us opportunities to trade, right? Let me check. Let's delete. Let's clear this once. Look here. The level, super strong. This one wasn't. And this one too, price didn't touch it on the next candle. Okay. Yeah. Strong level. Even this one here. These are strong levels. Yeah. When price comes to these levels, most of the time it will react. Okay. Yeah. So usually these are good areas for people who do scalping and people who want to enter their long positions. Okay. So another one here. Yeah, this one is a strong level too. Oh, this one is the one that I gave last week for trade. Yeah, super strong. Okay. Yeah, let's go back to here. All right. So the strength of impulse is how the candles moves after creating that nice level. Okay. And then the freshness of the level also it's important. Remember, a fresh level is the one that was never tested. Okay. So a fresh level, for those who somehow might have forgot, we said fresh levels are areas that were never tested before. Okay. Before you execute a trade, you consider that. Example, this area is a fresh level, meaning a trade you can be entered here. When price reaches this area, that's where you get in. This area is a fresh level, which means price never tested it again on the monthly time frame. Okay. Let's check something on the weekly. This also, it's nice, it's fresh. It was never been tested. This one is not fresh, it's tested, but before it was fresh. That is why price had to go back, touch it, and then it went down. So that's what fresh level means. Okay. So before you enter a trade, you have to check if the impulse, it moved up nicely or there were explosive moves. And next, we have to check if your level is fresh. All right. And those are for a high probability trades. Okay. Those are high, most around 80% of those trades, they work. Okay. Or they works, right? Remember, we said any imbalance is considered tested when price touches the area. Okay. The freshness of the level, it means the area was never been tested. The basin structure, it means we have nice, like price was falling. Okay. Price was falling, and to make just nice basis like that. Okay. That is a super good structure that you can enter trades on. If price was falling, and then after that it was creating this funny small candles, maybe this last one like that, after this like this, most of them poor structures. Okay. And then minimum risk to reward. What does that mean? Then let me show you. Okay. Okay, I'm gonna show you that. Okay. This it means when you look at the chart, okay, I think let me show you on the live chart what that means. I'll show, look here. This level here, all right? It means if you enter this trade, okay, your profit should be 2 times, a minimum of 2 times this area. Why? Because this is where you'll put your stop loss and this is where you'll put your buy limit. I get it. So it means your profit should be at least 2 times the area. Okay. Yeah, for here I had 1, 2, 3, 4. But the profit before your first take profit should be at least 2 times the area that was going to reach your stop loss. Okay. So why? This is very important for you also to be a consistent trader. Why? Because let's just assume that this stop loss is 20 pips. Okay. Is 20 pips. So it means you have to get out from that trade after making 40 pips. All right. Or the minimum for you to get out of trade is after you make 40 pips. All right. If you in terms of money, if you had to lose, maybe your stop loss was supposed to be 20, you are willing to lose $20 for this trade. I get it. So that's what you are willing to lose. But what you are willing to make as a minimum on this trade, it will be $40. That's what it means. This is what risk to reward ratio means. Okay. It means you should always be willing to make 2 times what you can lose. All right. Example here. Look, if I were to enter on this trade here, look, it was a valid level, which means my take profit will be, if I entered there, so my take profit will be somewhere here. Why? Because this, actually the half is here. Okay. Meaning that would be 1 and 2. Okay. That's what risk to reward ratio means. And it's very important for you to stay profitable. Okay. Why? Because if you adopt this, guys, it will help you not to actually, if you're already a trader, you might be noticing that you might find that 10 trades that you took, they were profitable, and only maybe 5 were not profitable. And when you look on your account, it's empty. Why? Is because you were not following or considering risk to reward. Okay. it risk to reward, guys, it have to be kind of like it's a religion to you. Okay, there is no way you can get on a trade, and before you make what you wanted to make, actually before you make it 2 times what you were risking, and then you want to get out from that trade. No, you have to wait to get to there. Okay, and this will help you to avoid getting out of trades earlier. All right, and it will also helps you as a trader to never end any month on a negative. All right. Okay. And the other thing that is important for you to practice as a trader, it's something we call trades management, guys. Okay. Trade management, it means if most of the time you are kicked out from your trades, you open, whenever you open a position, let's say you are planning to open 0.2, you open 0.1, 0.12 times, I get it. And then immediately when that trades get into a profit, maybe you can say 10 pips or 20 pips. Okay, what you do, you move your stop loss to break even, or you move your stop loss to an entry point. All right, so when that happens, it means if it goes against your analysis, you are not going to lose anything. If you are to practice that, you might find that most of your out of 10 trades that you'll take, doing that, you might find that around 70% of those trades will work out and only 40% won't work out. Okay, and if you follow proper money management, at the end of the day, you will be on profit. Okay, so this is what I wanted to share with you guys today, that it's not every level that you trade. You trade the levels based on what they have achieved. If they managed to consolidate away or moved away from when the level was created, was it managed to move away? Or okay, because actually what is happening on consolidations away, it means whenever you see those explosive candles, guys, it means it usually shows the footprints of the big traders, or you can say of the banks and the hedge funds. Okay, meaning there are more positions to be filled on those levels, right? That is why prices will move with those impulsive moves. Okay, so, and it's 80% of the time price will reverse to fill the positions that were not filled. All right, so that's what very important. Okay, so yeah, with that, anyone with the questions, guys, feel free to WhatsApp me any questions that you have. I'll answer them. All right, so that's the end of today's session.